Are you ready to discover the secrets behind the financial success of one of the most famous investors in the world? In this video, we dive into the financial world of Warren Buffett, nicknamed the Oracle of Omaha, to explore 9 common financial mistakes you must absolutely avoid. Whether you are a seasoned investor or simply eager to improve your knowledge of personal finance, this video offers a wealth of valuable insights to help you make informed decisions and achieve financial prosperity. Get ready to feel inspired and motivated to take control of your financial destiny. Lack of financial education. A lack of financial education is one of the first mistakes to avoid. A significant part of Warren Buffett's remarkable financial success is built on his deep knowledge and refined understanding of financial principles. Known as the Oracle of Omaha, he places great importance on thoroughly understanding the industries in which he invests. In contrast, a lack of financial skills can lead to poor decision-making and serious financial losses. Financial education is therefore not just an advantage, but a necessity for those who aspire to build wealth. Buffett himself emphasizes the importance of investing in yourself. It is clear that his fortune is not the result of luck, but of many years of research and study of companies, markets, and economic trends. This financial education equipped him to make informed investment decisions and to assess the risks associated with every financial choice. However, too many people venture into the world of finance without fully understanding how money and investing truly work. They make impulsive decisions or are tempted by promises of quick profits, which can lead to costly financial mistakes. It is therefore essential to develop your financial knowledge in order to make wise decisions and achieve long-term prosperity. By following Buffett's example, invest in your own financial education to avoid the traps of financial ignorance and continue on the path toward financial success. Living beyond your means. Living beyond your means is another common mistake. If Warren Buffett teaches us one crucial lesson, it is the importance of living within your means. Nicknamed the Oracle of Omaha for his ability to anticipate market movements, Buffett embodies frugality. Despite his immense fortune, he still lives in the modest house he purchased in 1958 for a relatively small amount. While other billionaires display their wealth through lavish residences and extravagant spending, Buffett prefers a simple and discreet lifestyle. He is not tempted by luxury cars. For years, he drove a 2014 Cadillac XTS as proof of his practicality. At the 2020 annual meeting of Berkshire Hathaway, Buffett emphasized the importance of this principle by stating, "If you buy things you do not need, soon you will have to sell things you do need." This maxim warns against the spiral of excessive consumption. By following Buffett's example, it becomes possible to set aside a portion of your income for future investments, thereby creating long-term financial security rather than giving in to the immediate gratification of consumer desires. Neglecting savings. It is crucial to emphasize the importance of setting money aside regularly in order to build wealth. Warren Buffett, often cited as an example, began practicing saving and investing at a very young age, an essential factor in his remarkable financial success. His wealth is not the result of luck, but of decades of financial discipline. At the age of 11, he bought his first stock and continued to save a portion of the money he earned from small jobs. This early dedication to saving and investing laid the foundation for his exceptional financial achievements. Unfortunately, many people neglect saving, living paycheck to paycheck without ever setting aside money for the future. This short-term approach can lead to financial difficulties, especially in the event of unexpected expenses or emergencies. Buffett has consistently highlighted the importance of saving in his speeches and writings. He advises, "Do not save what is left after spending, but spend what is left after saving." This simple yet powerful advice reflects his philosophy on saving and investing. By making saving a priority, you can set yourself on the path toward greater financial prosperity. Accumulating debt. It is crucial to understand the risks associated with accumulating high-interest debt, especially credit card debt. Exorbitant interest rates can turn even modest balances into an overwhelming financial burden, hindering your goals of financial independence. Warren Buffett, known for his financial wisdom, strongly advises against carrying unpaid credit card balances. He considers high-interest debt to be a major obstacle to building wealth, regardless of how large one's fortune may be. Buffett has frequently emphasized the importance of avoiding debt particularly debt with high interest rates. At the 2018 annual meeting of Berkshire Hathaway, he compared credit card debt to heroin use, highlighting the serious financial dangers associated with such practices. For Buffett, accumulating high-interest debt is like playing with fire. It can not only erode your current wealth, but also jeopardize your future financial security. Ultimately, he stresses the importance of avoiding unnecessary debt, especially when the cost of that debt is high. Steering clear of high-interest liabilities is essential to ensuring steady financial growth and achieving long-term financial prosperity. Impulsive purchases. Impulsive purchases, whether they involve stocks or consumer goods, can have disastrous financial consequences. Warren Buffett advocates careful thought and thorough research before making any purchase or investment. Unlike some investors, he is not prone to impulsive behavior when it comes to spending or investing his money. His reputation is built on diligence and a thoughtful approach to investing, thereby avoiding impulsive decisions that could lead to losses. He favors a methodical and cautious investment strategy, taking the time to carefully examine and fully understand each opportunity before committing to it. In a 1996 letter to the shareholders of Berkshire Hathaway, Buffett expressed this idea by stating, "We don't look to jump over 7-foot bars. We look for 1-foot bars that we can step over." This maxim perfectly reflects his prudent and deliberate approach to investing. This philosophy also applies to his personal spending habits. Despite his immense wealth, he avoids extravagant or impulsive purchases, instead favoring simplicity and frugality. These qualities have contributed to both the accumulation and preservation of his wealth over the years. Emotions. Warren Buffett emphasizes the critical importance of keeping emotions under control when investing. Emotions, especially fear and greed, can cloud our judgment and lead to serious financial mistakes. In the turbulence of financial markets, it is natural to experience surges of adrenaline or waves of panic. Greed can drive impulsive investments during market highs, while fear can trigger rushed selling when conditions deteriorate. Yet it is precisely in these moments that one must resist emotional impulses. Buffett offers an iconic piece of advice on this matter. Be fearful when others are greedy, and be greedy when others are fearful. He successfully applied this principle during the 2008 financial crisis by investing heavily in companies such as Goldman Sachs and General Electric, at a time when most other investors were paralyzed by fear. Rather than being swayed by market sentiment, he relied on his own logic and his deep understanding of these companies' fundamentals. The result? Spectacular returns when the market recovered. This essential lesson reminds us that allowing emotions to dictate our financial decisions can hinder wealth accumulation. It is crucial to master our emotions, remain rational, and make financial decisions based on careful evaluation rather than fear or greed. Failing to do so can become a major obstacle to building lasting wealth. The pursuit of quick wealth. The temptation to get rich quickly can seem irresistible. However, Warren Buffett has repeatedly expressed his disagreement with speculative investments and the pursuit of fast profits. He advocates a long-term investment approach, far removed from day trading and rapid speculation strategies. Buffett avoids risky transactions in favor of investing in solid companies with proven business models, companies he can monitor and understand over the long term. His philosophy is simple. It is better to invest in quality businesses at reasonable prices and let time do its work. In a 1996 letter to the shareholders of Berkshire Hathaway, Buffett summarized his strategy by writing, "Our favorite holding period is forever." He has also stated that his preferred approach is to invest in profitable, well-established companies managed by people he admires. These words perfectly capture his commitment to long-term investing and his rejection of quick, speculative gains. The lesson is clear. The pursuit of quick wealth can be a risky path filled with obstacles that may seriously compromise your financial health. Take the time to learn, invest in quality assets, and have the patience to allow your investments to grow over time. While it may not be the fastest route to wealth, it is certainly a safer and more stable one. Ignoring the power of compound interest. Warren Buffett openly shares the well-known secret of the magic of compound interest, to which he attributes a large portion of his exceptional wealth. Underestimating this powerful force can seriously hinder wealth accumulation. Compound interest, often referred to as the eighth wonder of the world, is the process by which the interest earned on your money begins to generate its own interest. Over time, this creates an exponential effect on the growth of your wealth. Buffett himself took advantage of this principle from a very young age. The money he saved and invested at just 11 years old continued to grow and multiply over the decades, contributing significantly to his present fortune. At the 2016 annual meeting of Berkshire Hathaway, Buffett illustrated the power of compound interest by pointing out that 99.9% of his wealth came from investments made before the age of 50. That is how compound interest works, and how wealth is truly created, not diversifying your investments. A fundamental principle of investing, strongly advocated by Warren Buffett himself, is not to put all your eggs in one basket. Failing to diversify is a risky strategy. Buffett has consistently recommended diversification to reduce risk, while also recognizing the importance of focusing on the most promising opportunities. Not diversifying your investments exposes your wealth to unnecessary risk. If one investment performs poorly, it can jeopardize your entire savings, like playing Russian roulette with your financial future. Buffett understands this principle well. Berkshire Hathaway, the investment company he leads, holds stakes in numerous businesses across diverse sectors, ranging from insurance and manufacturing to energy and retail. This diversification spreads risk and ensures that poor performance in one sector or company can be offset by stronger performance in others. However, Buffett also takes a nuanced approach to diversification. He believes in concentrating on the most promising opportunities, investing heavily in companies he understands and trusts. Diversification is essential, but it must be balanced with deep knowledge and strong conviction in your investments. Neglecting diversification can be a costly mistake that hinders wealth accumulation. In conclusion, Warren Buffett's advice is invaluable for anyone seeking to build lasting wealth. By avoiding these 9 common financial mistakes, you can lay solid foundations for your financial future. Don't forget to subscribe, share, and leave your feedback. Start making the right decisions today for a prosperous financial future. See you soon.